Have you ever stopped to think about what happens to the global economy while you're asleep? Not governments, not central banks, not financial analysts, but algorithms. Every second of every day, artificial intelligence systems are buying, selling, pricing, predicting and reallocating trillions of dollars across global markets. Most of these decisions happen faster than any human can react. Many happen without direct human involvement at all. The strange part is that most people never see it. There are no headlines announcing every AI-driven trade. No alerts telling you that an algorithm has just shifted millions of dollars between markets. No public dashboard showing the hidden systems that increasingly influence the world's financial activity. Yet these systems are becoming more powerful every year. Today we're exploring the growing influence of artificial intelligence on global economies, how autonomous trading systems are reshaping financial markets, why regulators are struggling to keep up, and whether we're entering a future where economic power is increasingly controlled by code rather than people. Welcome to the invisible economy. For decades, financial markets were driven primarily by human decisions. Traders analyzed information. Investors assessed risk. Fund managers made strategic choices. Markets moved because people made decisions. That world has changed dramatically. Today, a significant percentage of global trading volume is executed automatically through algorithms. These systems analyze enormous amounts of data in real time, identifying opportunities and executing trades within milliseconds. By the time a human trader notices a market movement, an AI system may have already completed thousands of transactions. The result is a financial ecosystem operating at a speed that traditional institutions were never designed to monitor. Many experts describe this as a form of digital shadow infrastructure, not because it is illegal, not because it is secret, but because much of its activity happens beyond human visibility. Complex AI systems constantly interact with one another, responding to market signals, economic indicators, news reports, social media trends, supply chain disruptions, and even weather forecasts. The sheer scale and speed of these interactions make them difficult to understand, even for the organizations operating them. This raises an important question. If economic decisions are increasingly being made by machines, who is actually in control? The answer is more complicated than most people realize. One of the most fascinating developments is the growing gap between financial market performance and traditional measures of economic productivity. Historically, economic growth was closely linked to human labor. People worked, businesses produced goods and services, economic value increased. Today, however, markets are increasingly influenced by information rather than production. Algorithms do not care how many hours someone worked. They do not care whether a factory is busy. They do not evaluate effort. They evaluate patterns. If a pattern suggests profit, the algorithm acts. This creates a new reality where data itself becomes a valuable economic asset. Companies that control massive amounts of information can generate extraordinary value without necessarily increasing their workforce at the same pace. This has led some economists to question whether we're entering a period where wealth creation becomes increasingly disconnected from traditional employment. That does not mean humans are becoming irrelevant, far from it, but it does mean that the relationship between labor, productivity, and wealth is changing faster than many institutions can adapt. At the center of this transformation sits what many researchers call the black box problem. Modern AI systems are incredibly sophisticated. Some utilize advanced neural networks capable of processing vast amounts of information and identifying relationships that humans would never discover. The challenge is that these systems often cannot fully explain how they reached a particular conclusion. Even the engineers who build them may understand how the system functions overall, yet struggle to explain why a specific decision was made at a specific moment. In industries such as healthcare, aviation, or law, this raises important ethical questions. In finance, it raises potentially systemic ones. Imagine a trading algorithm moving billions of dollars based on patterns that nobody fully understands. Now imagine thousands of similar systems interacting with one another simultaneously. This is not science fiction, it is increasingly becoming reality. Financial institutions spend billions developing faster and more sophisticated AI-driven trading systems because even tiny advantages can generate enormous profits. As a result, markets have become an arena where algorithms compete directly against other algorithms. Some systems are designed to identify weaknesses in competitors. Others analyze behavioral patterns. Some react to market signals in fractions of a second. The competition has become so intense that speed itself has become a strategic asset. This has created extraordinary efficiency, but it has also introduced new risks. One of those risks is the phenomenon known as a flash crash. A flash crash occurs when automated systems trigger a sudden and dramatic market movement within seconds or minutes. In many cases, prices recover quickly. However, these events demonstrate how rapidly automated systems can amplify instability. When algorithms respond to one another rather than underlying economic fundamentals, feedback loops can emerge. One system reacts, another system reacts to that reaction. A third system responds to both. The process accelerates. Before humans fully understand what is happening, markets can experience significant volatility. Fortunately, modern exchanges have implemented safeguards designed to reduce these risks. Circuit breakers can temporarily halt trading. Risk controls can restrict activity. Regulators continue introducing new oversight measures, yet concerns remain. As AI systems become more complex, ensuring stability becomes increasingly challenging. This is why policymakers around the world are now debating the future of AI governance in finance. Major financial centers are exploring new regulations designed to increase transparency, accountability, and human oversight. Some proposals would require human approval for certain high-risk decisions. Others focus on explainable AI, ensuring that financial systems can justify their actions in ways regulators can understand. There is also growing discussion around independent auditing of AI systems. Just as financial statements are audited today, future AI systems may require regular examination to ensure they operate safely and fairly. At the same time, some researchers argue that greater transparency is essential. Many of the most influential financial algorithms remain proprietary. Their owners consider them valuable intellectual property. While understandable from a business perspective, this creates tension between innovation and public accountability. If AI systems play a critical role in economic stability, should society have greater visibility into how they operate? That debate is only beginning. Looking ahead, the question is not whether AI will influence the global economy. It already does. The real question is how we manage that influence. Artificial intelligence has the potential to create more efficient markets, better risk management, faster responses to economic shocks, and entirely new forms of innovation. At the same time, concentration of power, lack of transparency, and increasing complexity create challenges that cannot be ignored. The future will likely require a balance between innovation and regulation, a balance between automation and human judgment, a balance between proprietary technology and public trust. The global economy is entering a new era, an era where code, data, and algorithms increasingly shape financial outcomes. The systems operating behind the scenes may be invisible to most people, but their influence is becoming impossible to ignore. The question is no longer whether AI will reshape the economy. The question is whether humanity can ensure that the future economy remains understandable, transparent, and ultimately accountable to the people it is supposed to serve. Because if the next economic revolution is being written in code, then understanding that code may become one of the most important challenges of our time, and that future is already here. If you enjoyed this video, subscribe to Snobbots for more insights into artificial intelligence, emerging technologies, and the future that's being built around us every single day. This is Snobbots, where mind meets machine.